I can't say I'm a regular reader of Barron's, but in walking by today, I saw the 2020 roundtable says 2020 is the year of flat markets. I'm going to discuss why that might be the case and what you can do about it. So do flat times lie ahead? What does that even mean? Why would that be the case? And most importantly, what would you do about it? So first thing we'll discuss is what moves markets at all. I think this is an important discussion. There's really two big things that are going to move markets. Number one is people are willing to pay more for whatever reason for that same dollar of earnings. They're just willing to pay up. The second one is that company is in fact worth more in the sense that it's earning more. And so it's those growth of those earnings that are going to push that growth price. You can certainly have both, and that can lead to quite the cocktail in terms of market performance. 2019 was almost entirely about multiple expansion and or people being willing to pay more for that same growth of earnings. But as most experts, including our famed managers here in Barron's, would have to admit, the valuations are at a point right now where it's not likely to be a whole lot more of that multiple expansion, which leaves us on the need to have earnings continue to grow to be able to propel the market higher. So how likely is that to happen? Well, as a general outlook, a recession, a true recession, pretty unlikely in 2020. Federal Reserve money's still pretty easy. Tax code's still pretty favorable to companies. International markets, or economies, are starting to pick up a little bit. So I think there's little question that corporate earnings should grow this year in general. I think the problem comes in what people are expecting, and that's what was discussed actually in this article as well. A lot of the other analysts that we work with have the same sentiment. Maybe half what expectations are. Current expectations for 11 to 13. Most people, that number is probably closer to 4 to 5. Throw in some dividends, you get 6-7% type rate of return. Why do we see some headwinds to that? Well, number one is growth still relatively tepid in terms of the macroeconomy, but inflation's ticking up. And what that does to corporate earnings then is cost of goods are going up, cost of labor is going up, but how much stuff you're selling or the price you can sell it for is relatively muted. That squeezes profitability, squeezes some of those earnings that we talk about. Similarly, is just listening to the leaders of these companies themselves. In the most recent study of CFOs that came out, 97% of respondents said a slowdown had begun and that they would likely be cutting back expenditures as a result. It's that type of behavior that, again, puts a damper on the economy. And lastly, we had a macroeconomic indicator come out this week that is a bit ominous, much like an inverted yield curve. Of all things, it's the much lesser known job openings hard to fill index. But when you look at that, it does have some real important leading indications of where things might be headed. The 6-month number just dipped below the 2-year number. What that means in short, labor market's getting a lot tighter. That inversion, much like the yield curve inversion, has occurred before the last 4 or 5 recessions. So something to keep in mind, not a recession call, but just to say there are some headwinds that make this picture maybe a little bit less rosy than everybody's feeling with markets hitting all-time new highs every day. What do we do then? Well, number one is keep in mind the easy money's off the table. Bespoke put out a piece this week where they said this is the earliest in the calendar year since 2018 where markets have gotten within 5% of their calendar year price target. Simply put, if we come back to that, we think the S&P is going to be up 7% as a consensus outlook, and we're already up close to 3%. Half that return is off the table, okay? And now where are we going to go with this type of earnings headwind? Same article, a lot of the same results to tell you. It doesn't mean things from a longer term perspective, 6 to 12 months out, still can't be positive. And in fact, in almost all those cases, they are. It can mean some short-term headwinds, and it can mean some of those expectations, which for people chasing Tesla stock, et cetera, can be getting quite high right now, maybe need to be dampened. Again, not a call on Tesla. Second thing is to evaluate your time, your money, and your emotion, and make sure whatever plan of attack that you have is being respectful of all three of those. They're all relatively finite buckets for any of us, and that plan needs to be ready. Coming back to emotional is, it is listening to these videos, it is dampening expectations, and or if things are dour as they were in 2018, realizing that things will improve. Getting your time and your money right is really the answer to flat markets, particularly if you're in retirement, in the sense that you need to have a plan. You need to understand what dials can be moved, what the timing of what events can be put off, and what money is going to be needed today and tomorrow and the day after that in terms of usual monthly living expenses. And then with respect to getting your money right, having income sources that can meet those needs and those expectations, whether markets are flat, down, or up, so that you can ride through all of those different scenarios. That's a place for those of you who are clients we want to get you to. That's what we're so excited to be able to show you very cleanly in our new client portal and app. And for those of you who may not be clients, that's what we're here to help explain or help you through anytime. And with that, I want to wish you all a wonderful weekend and look forward to talking with you soon.